Welcome to our first market update for 2026. So in today's video, we're going to walk through our key market views, both in terms of the share market outlook, as well as fixed income markets, inflation, interest rates, and then we'll just give a very brief overview of some of our preferred exposures within the market itself. So firstly, in terms of key themes, we'll start off by talking about equity valuations, which are very expensive any way you cut it. They're the highest in several decades at a global level. And so that just means there's a low margin of safety within the stock market. The other key risk that's out there and playing out in markets at the moment is geopolitical risk and trade wars. And we think both of these present risks to both inflation as well as economic growth. On the positive side, though, investment trends do remain very supportive for markets such as the US, where there's a heavy growth and technology bias. And so what that means is that earnings growth in the US is expected to be about 15% this year, which is well above trend. And here in Australia, earnings growth has actually accelerated over the last 6 months and is expected to be about 10% for this calendar year. So both of those bode well for corporate earnings growth and therefore the stock market in absence of any external shocks. Interest rates are diverging. So we're expecting to see no rate cuts here in Australia this year. We're actually expecting a couple of rate hikes. But in the US, we're still expecting to see a few rate cuts. So that simply means that there's going to be different levels of return within fixed income markets as they relate to different geographies. Within fixed income investments in particular, we still think there's a good level of return for the risk within private credit markets, as an example. And we continue to look for more opportunities in that space, particularly in offshore markets where we can diversify away from the Australian property-based lending, which is a significant proportion of the private credit here in Australia. And finally, we think investment selection is going to be more important going forward, given some of the diverging factors and trends that we've just talked about. In terms of equity performance, looking at the last 12 months, you can see that the US market has delivered about a 17% return and the Aussie share market's done about 10. And both of those numbers are inclusive of dividends, which here in Australia are quite significant, circa 4.5%. That's against a backdrop where earnings have grown quite strongly in the US, so quite a healthy setup, whereas in Australia, earnings growth has been a bit more benign, only growing at about 3%. In terms of breaking down the different sources of return over the last year, in Australia, a significant portion of the return has come from valuation expansion, which is the grey bar on the left-hand chart there, as well as dividends. Whereas in the US, by contrast, you can see a significant portion of the US earning or performance contribution has come from earnings per share, which is the green bar. A little bit has come from valuation expansion, but a good portion has come from fundamental earnings growth, which is definitely a healthy condition. The other thing to point out in terms of stylistic performance is that value has actually done pretty well at a global level relative to growth. And a lot of that has been driven out of geographies like Europe, where value stocks like financials and industrials have done really, really well. Whereas in the US, value has actually not done very well at all. It's actually gone backwards in the last 12 months. So it's really been a case of different styles working in different geographies. And we expect that type of performance breakdown to continue going forward, where different geographies are going to present different opportunities in terms of sectors and stocks. Within fixed income, as I mentioned, the US is expected to see a couple of rate cuts this year, whereas here in Australia, markets are pricing in a couple of rate hikes. And the key difference between the US and Australia is that inflation in Australia is a little bit more above the target from the central bank relative to the US. I guess a consequence of this is that the long end of the yield curve is rising relative to short end, and part of that is that governments continue to increase their debt loads, which means that the rate of return that investors require on those long-term debt instruments will go higher. And at some point in the future, higher debt costs do come home to roost and do limit the ability for governments to issue debt. But that is probably something that will play out over the next 6, 12, 18 months rather than imminently. Just briefly, in terms of global valuations and global growth, I've already talked a little bit about it, but the US sits on the far right-hand side of this chart, meaning it's the most expensive global equity market. And the Australian stock market, the ASX 200, whilst expensive, kind of sits in the middle of the pack as far as valuations go. But as I said earlier, earnings per share growth do remain very, very strong in the US, which does continue to support allocating to that market. Whereas here in Australia, growth is a little bit lower, circa 10%. And as I said, in terms of valuations and what that means for margin of safety, quite simply, it means that the higher your starting valuation, the lower your future return is expected to be, all else equal. And the reason I say all else equal is that valuations can persist at high levels if corporate earnings growth remains very strong. And there are good fundamental reasons why that earnings growth outlook and trajectory do remain strong, particularly in places like the US, where there's a significant and persistent runway of capital investment in technology driven by AI demand trends. So this is just a very quick visual just showing the earnings per share for the US stock market in orange, which continues to trend higher, which does support that equity market price in blue. And as I alluded to before, corporate earnings growth from a long-term perspective, sitting at 15%, is toward the upper end of the very long-term averages there, which does support us pushing capital into the US equity market. In contrast, the ASX 200, what we've seen over the last 6 months is share prices have pretty much gone sideways for that time. And earnings per share have actually ratcheted quite a bit higher over the last 3 months in particular. And this is quite interesting because when we look at the largest component of the ASX 200 being the banks, they have actually not seen any improvement in earnings per share over that time frame. So what we're kind of thinking about here is that the Aussie share market doesn't look too bad in aggregate, and in fact looks quite attractive when you strip out the banks, which to us don't look very attractive at all. So we have a bias when we think about Australian shares to equal weight or mid cap or small cap exposures, as opposed to market cap weighted exposures, which have larger allocations to the banks. So we want to have less exposure to the banks given the dynamic that we're seeing with lower earnings growth and high valuations within the banking sector. And just to kind of put a finer point on that, the chart on the left-hand side just shows the earnings per share growth for the different sectors in the Aussie stock market. And you can see the financials, which is largely the bank, sits at the bottom of that earnings per share grouping. And the chart on the right just shows the fact that the financials remain pretty much at the most extreme valuation in the last 15 years. So not a place where we really want to be allocating new capital to. In contrast, healthcare as a sector does look to provide pretty good earnings growth and is one of the cheapest sectors here in Australia. Within the US, same sort of story. However, earnings growth across the board remains very strong. Healthcare in particular does look very good. And from a valuation perspective, you can see that valuations sit pretty much at average levels, whereas most other sectors are sitting well above averages there. In Europe, it's a pretty similar picture. financials and healthcare actually look the most attractive when we balance both growth and value. And so there are a range of companies that we like to have exposure to in our portfolios in Europe, across those sectors, being companies like ING, Roche, Partners Group, as well as Novo Nordisk. Within the US, mega cap, Magnificent Seven, complex, what we really want to draw attention to is the fact that earnings per share growth remain very, very strong. In fact, for most of these companies, the earnings trajectory has improved in the last 6 months. And when we look at valuations, for most of these names, they look pretty reasonable, particularly in context for the strong earnings per share growth. So PEG multiples sit under 2 for most of them. The two exceptions are Apple and Tesla, neither of which are preferred names in our portfolios, but Amazon, Alphabet, Microsoft, Nvidia are 4 names that we do like within that magnificent complex, given the strong earnings per share growth and undemanding valuation multiples. Small caps we've talked about in prior videos, but we continue to see good relative value in the small cap part of the market, notwithstanding that small caps have had a pretty good rally in the recent past. But we still think that on a relative basis, both valuation and growth look pretty attractive in that part of the market. So putting it all together, what are the implications? It's really that equities do remain a viable long-term growth engine within portfolios. But we think that given where valuations sit, there could be bouts of volatility in the market. So we just have to be prepared to withstand that volatility when it comes along. We do have a preference for international over Australian equities, given the breadth and quality of opportunities offshore. However, as I've highlighted in today's video, Australian equities, ex the banks, look a little bit more interesting than they have in the last 6 to 12 months. So that's definitely an area where we could potentially be thinking about dipping into. AI winners, we think, will continue to be winners within the stock market, given the corporate earnings growth trajectory for those names. Healthcare, we've been talking about for the last few quarters as a sector that we like for quality, for growth, and for valuation reasons. Fixed income does also remain a source of attractive risk and reward, given that particularly in areas like private credit, where we're getting 7 to 9%, and we sit in a senior position of the capital stack, and in a lot of cases we have solid collateral backing our positions, which means that if there is a downturn in terms of the economy, unemployment rises, bad debts start to increase, we do have that level of protection provided by that collateral and that senior position in the capital stack. Cash is a better option than it has been in some time, given where valuations in the stock market are at. So cash should be thought of as being an opportunistic lever that people can pull if there is a dip in the market. And finally, asset allocation and rebalancing are always 2 of the key pillars that we look to use in terms of managing and aligning portfolios with client risk profiles, and also just the rebalancing process that happens where we're trimming the top off positions that perform very well and just adding incrementally to names that may be having a bit of a short-term pause or dip. So thanks for your interest. If you do have any questions, reach out to your advisor.